Okay, but another way, of course, to become rich is also investing assiduously in a disciplined manner. And, the guest I have with me today has been a proponent of that. In fact, he believes that this formula is something that can also leave your kids with a legacy of almost 1,000 crore rupees. However, it looks like at this point of time, Indians are not really following, that basic principle. Mr. P.V. Subramanyam joins us now on the show. Mr. Subramanyam, thank you so much for joining in. It's always a pleasure having you with us. Now, the last 2 months, we've seen investors, mutual fund investors, redeem more than they are investing, whether it's lump sum or whether it is SIPs. Why do you think this is happening? I mean, do you think this is just a case of where investors are seeing that, oh, okay, look, the Nifty and Sensex has gone up. Let me just quickly book some profits from my mutual funds?
Thank you, Mubina. Yeah, all these things are happening. One is, when a 53-year-old pilot loses his job, he's not sure whether he'll get it back. So maybe his retirement has already happened at 53 instead of 60. So some withdrawal will happen for him to meet his household expenses, and his ability to invest money is also reduced because he cannot put in money because he doesn't have a salary. Now that is true for very many people. I was just at a shoe shop, and all the boys there have been asked to go home because they've gone to the village. They've not been paid salary. So if these are the typical kids who are doing 1,000 and 2,000 rupee SIPs, they have stopped. And the big people who with big salaries have also been asked to take a cut in salary. So a lot of people are not putting. Now, why are people redeeming? Same reason why people are redeeming from their EPFO. If you see the EPFO, again, there'll be some 30,000-40,000 crores of redemption, where people are withdrawing from their provident fund to meet their day-to-day expenses. Now, this is not something very great, but the fact is, we have to accept that this is happening, and this is happening perhaps for people to meet their immediate liabilities or what have you, and therefore they are withdrawing.
I completely get it. I mean, if somebody has lost their job, obviously, I guess they are going to start looking at their assets when it really becomes a horrible situation. What would be the pecking order according to you, Mr. Subramanyam, if I actually have to go in and, sort of liquidate my savings, assets, you mentioned Provident Fund, mutual funds, of course, we are seeing that phenomena. But of all my assets, I mean, is there a pecking order? Because if I look at Provident Fund, I think that, look, this is my nest egg. And then if I'm looking at mutual funds, I feel that, oh, but I have to also invest in the long term. So how should one essentially sort of starve off this period of lull where I'm jobless, but I still of course need to feed myself and my family?
So the most difficult thing to ever liquidate would be real estate, because you'll not be able to sell real estate during such a situation. So selling real estate is out. If you have old endowment policies of LIC, of even of a private sector companies which are now 20 years old, that would be the best, because there you're anyway going to get only 6 or 7% return at best. So best is to redeem that or take a loan against that you may be able to get at 8 or 9%. That would be the pecking order. But what happens is the easiest to withdraw is the mutual fund. At a click of a button, all those things which were told to people, इसमें कभी भी आ सकते हो, कभी भी जा सकते हो, no entry load, no exit load. So people are listening to all that, and now they're implementing. They're saying, oh, I need money here. At a click of a button, I can get it from a mutual fund. The easiest money to redeem is, of course, the mutual fund. So people are redeeming more from mutual fund than from insurance company. Provident fund, perhaps those people have already redeemed their mutual fund and therefore they're withdrawing from their provident fund. So these would be the reasons. There's nothing. If you have equity shares, if your shares, largely people sell whatever is doing well. So if they bought a share at 10 rupees, which is now at 20 rupees, they would sell that. But they bought another share at 10 rupees, which is at 8 rupees, they will not sell that. So like what Peter Lynn says, watering the weeds and plucking the flowers, people will do. They will sell their best shares and they will keep their badly performing shares.
Yeah, I guess, that's human nature as well in many ways. Okay. The other phenomena that we're, also observing, I mean, not sure, of course, that they're correlated. I think largely the opinion is that, whatever we are seeing in terms of direct share trading, they're all new investors. But yeah, of course, I mean, one really will not be able to ever establish that. But the fact is that today, in the share market, in direct shares, there's the footprint of retail investors. I mean, even the average turnover has gone down. That's a typical characteristic of a retail investor or you know, a retail individual. You are seeing heightened trading activity over there. Is this okay? You know, because on one side you're seeing you know, an investor thinking that, oh, okay, market has gone up, let me just take off some money, or for whatever reason, like you mentioned, you know, got to feed themselves. If someone has lost their job, they might as well start redeeming their funds. But then again, at the same time, you're seeing increased share trading activity. Is this also perhaps indicative of people saying that, look, you know what, I'm seeing this Nifty go up right in front of me, I'm not seeing the results in my mutual fund, so let me just go directly and, you know,
Yes.
engage in direct share trading?
Yes, that is the other possibility. And it's amazing. You go to Google and say in India, which are the best shares to buy. It throws up very interesting names. It throws up Asian Paints. So you don't know what to buy. You go and buy Asian Paints, and maybe in 1 year, 1 month, you may even make some money. You put 10,000 rupees and it may become 11,000 rupees, and you guys thrilled. So is this the way to invest in equity? I don't know, but it is working for some people, right? So then there are websites which say BTST, which means buy today, sell tomorrow. So you buy Asian Paints today at 10 rupees and tomorrow you sell it off at 10.50 or 10.30, whatever. So these kind of websites are helping people who do not know whom to ask. Then all these broking companies, if you see the result, they are booming. They assign a relationship manager to you, and he calls up, and every day he tells you 4 things to buy and 4 things to sell the next day. So yes, obviously there is heightened activity helped by the BFSI, who is leading them up the garden path. Some of them will make money, some of them will lose money. But if 50 lakh new accounts are opened, maybe 25, 30 lakhs make money, 20 lakhs lose money. So those who lose money may go away, but those who make money will keep coming back. So every day new people are added, and every day somebody is making money, somebody is losing money. So I guess the guy who's making money is coming back again and again.
Yeah, you know, whenever you get that first shot right, it could be beginner's luck, or it could actually be maybe, you know, in many cases that the person does have the knack for identifying a good share trade. But it definitely does give this boost of confidence, which, like, you know, Mr. Subramanyam mentioned, causes people to, you know, come back again and again, you know, to in the share bazaar. So again, but we'd like to keep our focus, you know, on mutual funds, especially because a lot of individuals do not really either have, you know, the resources or the financial capability to be able to indulge in share trading, not to mention, of course, the time, because many of us do have other jobs going on, you know, whatever that may be. So mutual funds, do you think that a mutual fund is the instrument devised for the kind of activity that we are witnessing? Let's assume that, you know, somebody does have their job and they don't really need the money, but many a times people are also looking at it like we had Mr. Sunil Subramanyam, the MD of Sundaram Mutual Fund, saying that what we are observing is that many people are looking at the market and thinking, let me take some money off. But Mr. Subramanyam explained why, you know, a mutual fund is not the correct instrument, you know, to do something like this, where you can just take some money off because the market is up.
Yeah, it's very expensive because if you get out within 1 year, you pay an exit load, and you pay 20% income tax if you make profits. If you're making losses, there's no point in getting out. However, like I said, people will do this watering the weeds and plucking the flowers. So they've invested in a mid cap, large cap, and a small cap fund. They find that they're making money in the large cap fund. They will remove the large cap money and they will keep the small cap money. And wherever they're making profits, some of the profits they will book, and they will say, okay, mera itna loss kam ho gaya. Let us say they're 10 rupees, they've invested, the NAV has become 20 rupees, and from 20 it becomes 19. They will say, oh, I've lost 1 rupee. So next day they will go and redeem. So people redeem because they are making money. So any fund which is making money for them and they are in the plus, they will very likely redeem and say, I will wait. And there are other people who redeem and say, you know what I did, Subra? I removed all the money from my equity funds and repaid my housing loan. Now, this is such a rotten thing to do. But yes, people do this, especially when they're uncertain about their jobs.
Okay. All right. You know, Mr. Subramanyam, why do you think that that's not the best thing to do when someone sort of redeems all their mutual funds to pay off their loans? I mean, I'm sure this is a thought that may have you know, come to a lot of people's minds. So why are you against it?
No, I'm not against it. I'm saying if your job is there, you have a good job, it is paying you well. Based on that, you took a 20-year loan. Based on that, you also said, I will do an SIP of and so,
Yeah.
and therefore I will make sure that my retirement plan gets filled up. Now suddenly you change because you see the ticker moving, right? So don't get moved by the ticker. See what you want over the long run. Mubina, what I say today can look very smart. Ye hona chahiye tha. What I'm telling you is, if you had invested, if you had removed money in the month of January and you had repaid your loan, you would look very smart today because the market has come down. However, if you do it now, 6 months later, you could look like a complete idiot if the market recovers. Because if you see interest rates now, this is perhaps the best time to be borrowing, because the interest rate for a housing loan is at 7.30. When have you seen it? I'm sure you have not seen it. You must have been in school when it happened at 7.30. It was real long back. So this is not the time to be repaying your home loan. This is the time to be staying steady with your asset allocation. If anything, sit with your financial advisor and decide what to do. Don't react in panic.
Okay. All right. Let's talk now about how we've seen different categories. Where is there the most redemptions, where not? And Mr. Subramanyam, liquid funds were this one category that was resilient, which was ever so popular, because in the last month as well we saw this massive inflow come in. Perhaps people were looking at fixed deposit rates and saying that it's obviously quite a pitiful sight, because like you mentioned, if home loan rates are low, and they are the lowest that we've seen them in a very, very long time, even FD rates are going to be low. But again, we need to understand liquid funds are largely a category where institutions and corporates are there. But now we are seeing this bout of redemptions come by in liquid funds. Could you pinpoint any reason for it? I mean, do you think it's still a great space for people to park their funds versus a savings account or something?
See, there are two funds which have been badly affected by the stamp duty. You can't put a stamp duty right in the middle of time when everybody is trying to see how to, put more money in the hands of the investor. This government brings in a rule. Of course, the stamp duty was supposed to come in the month of April. It kept getting postponed. So now it has become very unattractive to move money into your overnight funds and move it out. Okay, there is a 0.05% charge on it. So all the yield is taken away by that charge, right? So therefore, what is happening is not excessive redemption. The redemption are the same, but new fresh money is not coming into these funds. Therefore, it looks like a negative. Because 15,000 crores is not too big for a liquid fund. But your overnight funds, I think, have just vanished. I don't think too much any money will come into this because of this very small stamp duty. But yes, on a one-day basis, it really hurts. There's no credit being given for it. So it's not, the rate is very hurtful in absolute terms. So these two funds seem to be hurt maximum by this duty. So I think that is the reason why this has happened. Also, many companies might say, let me keep my cash with me and let me keep it in the bank. So if you see the banks are floating with money. So some of this money would have gone and stayed in the current accounts of corporates.
Okay, well, that's largely the kind of trend that we've witnessed here. There have been two funds, liquid fund and overnight funds, that have seen a lot of redemption. Well, folks, if you want to get your financial plan as well checked out by Mrs. Subramanyam, you can always email us on themoneyshow@etnow.tv. If you as well are confused on how to start off in your investing journey, email us, themoneyshow@etnow.tv. For now, let's take on board some questions and queries we've received. Our very first query coming in from Santu Mundal, a very interesting one. He says, what type of mutual funds in both equity and debt should not be bought in general? What categories should be avoided by somebody who's young, say 30 years old, and what should be avoided by people who are older, because they cannot review and rebalance themselves? So it's purely in the negative. He wants to know what should he avoid. But again, I mean, if it really had to be avoided, I guess AMCs would not release such mutual funds. Plus, I'm sure Mr. Subramanyam, you'll agree that it also depends on each individual, their risk profile.
Yeah, but Mubina, the first thing is, when a person comes and asks such a question, it's very clear that he doesn't know where to invest. So first step should be to get an advisor. Because whatever answer we give here is good, but then he may not know how to interpret it. So what is something in which he should not invest at all is something which you don't understand, is when you chase immediate returns. So if you take the US-based funds, last 2-3 years, they've given very good returns, fabulous returns, maybe over 5 years. So those are funds which you have to avoid. Especially if you're young, you have actually capacity to take risk and all that. So if you are trying to do it on your own, you will find it very difficult to spot these funds because you have a Chinese fund, you got the Asia fund, you got Europe, you got US. So you will not find, but those are also necessary perhaps. But if you, my argument is very simple. If you will find an advisor, then look at a large cap, mid cap, and a small cap fund. You can also look at international funds. You can look at hybrid funds. But if you will not find an advisor, then the best thing for you to do is to put money in an index fund, because these funds have a lot of risks in them, and you may not find it necessary to do it. So stick to an index fund till you learn what is happening. After that, try testing the waters with a large and mid cap fund, or a mid cap and a small cap fund, or even a small cap fund. Try entering all that very slowly, one toe at a time kind of a thing. If you can put 10,000 rupees a month, put 10,000 rupees in an index fund. 1 year later, you can try a large cap, mid cap fund and all at 1,000, 2,000 rupees, and then see what is happening. After you understand, you can change. Or like I said, the first route, get a financial advisor and then listen to him and learn from him. What are the funds to be avoided for an older person? Definitely don't go beyond the ultra short bond fund and the liquid fund, because credit risk fund, if you ask me, is a great fund to be investing now, because everybody is running away from those funds. Those funds will give you good yield. But how many of them have the patience to stick around there? Because suddenly if they find something wrong, they will go and redeem, they will pay unnecessary amount of tax, right? Up to 3 years, it is short-term capital gain tax. So that up to 3 years, if you want to keep the money in a debt fund, you're better off keeping even in the bank FD. I don't think you're going to get a much higher return than a bank FD in any of these funds. Now, if you're doing it to save income tax, because to hold it for 3 years, you will pay lesser tax because you will pay capital gains tax. That makes sense. But again, this is a 3-year lock-in. So based on all this, based on your current risk profile and current understanding and your tax situation, your advisor will tell you what to do. I think that makes sense. If you don't want an advisor, stick to liquid funds and ultra short bond funds. And in the equity space, stick to index funds.
Okay. Well, step one is, of course, consult a financial advisor, and yeah, I mean, the easiest way to start off is, taking an index fund. Okay, very quickly, let's take on board our next question from Mr. S.D. Gopalakrishnan. He says, what is a frequency with which mutual funds, particularly short-term duration funds, churn the constituents of their portfolio? And secondly, he wants to understand what's the impact of an RBI's proposal to buy large quantum of government bonds on liquid fund returns. I guess very newsy as well, because we've seen the RBI conduct OMOs, but where they are buying and selling bonds at the same time. So maybe Mr. Gopalakrishnan missed out on the second part, where they're also selling bonds. But yeah, what is the implication of that, Mr. Subramanyam, on liquid fund returns?
See, when the government puts in 1.5 lakh crores of rupees at 3% in the market, straight away all banks have access to a huge amount of money. So banks are very likely to call on their bonds. So there is an SBI bond which is maturing in March, which was paying 9.95% coupon. Do you think SBI will continue to keep that bond in the market? The answer is no. So in the month of March, they will call on it. Call means they will say, please return this money to us. Here is your bond and here is your interest rate. So all the high yielding bonds will disappear. But SBI would be raising money today also, even at 7.5%, if it wants money for 10 years. So for the longer duration bonds could be at higher interest, but the lower duration bonds would all be at 3%, 4%. See the amount of money floating in the banks, in the current accounts and saving bank accounts. So what is likely to happen? Your ultra short bond funds, your liquid funds, and all of them will see interest crashing to 4% or sub 4%, right? That is what will happen. Other than that, whatever funds are there at a higher YTM, if there are no call options, then those YTMs will play out. Otherwise, you will see all over interest rates coming down. Interest rates will only crash because of two things. One, not too much of borrowing happening. The the user, which is the industry, is saying, I don't have business, why will I borrow money? So he's not borrowing money. If anything, he's repaying money. So I think interest rates will be tepid, expected to be lukewarm. I don't see interest rates going up in a hurry.
Okay, all right. Well, there you have it. I hope that explained everybody about how the entire operations conducted by the RBI when they buy and sell bonds affects liquid fund returns. A very simple explanation. So the next time you see something like that flashing on ET now sticker screens, I hope you're able to sort of gauge the implications of the same. But unfortunately, that's all the time we have to take your questions. Mr. Subramanyam, thank you so much for joining us on today's episode
My pleasure.
of The Money Show.